Welcome, everyone, to my Pinnacle Network's webinar on exit planning, where to start, what to think about, getting some answers on that topic. Today, we have several experts who will weigh in on this subject, including Paul Cronin from Touchstone Advisors. He has more than 30 years of experience working with M&A transactions. Bob Karlis from Cabot Business Brokers, former CEO and startup leader who has bought and sold numerous businesses himself. Paul Corrigan from Rosetta Valuations, and he is a valuation expert of trying to get your arms around what your business is worth in numbers. And then I am your host, Steve Dubin from PR Works. I have a lightly used public relations firm, and I'm one of the principals of my Pinnacle Network as well, which is a business-to-business networking group. So let's get started. I think maybe let's start with the greatest common concern of when people start to think about selling their business, whether they're aging out, whether they're burnt out, whether they're moving on to another venture. What is their greatest concern when they are selling their business? And I put that out to any of our three experts who can respond.
Well, I got to jump in.
Good.
Being a business broker for 25 years, I've come across all kinds of reasons to exit a business. But I think the biggest concern is what's involved in the process, what's ahead, how do I go about doing it? And if I'm comfortable with the process, then I can formally make the decision to sell the business. But not understanding what my real value of the business is, or what's involved in the rigmarole to prepare it, or what's the process. They're hesitant.
Okay. And Paul Corrigan, can you weigh in?
Yes, I think a lot of it is just understanding all the changes that go with it. I've had cases where a business owner says, I'm getting ready to retire. I'm going to be around the house all day, helping the yard. And the spouse goes, no, you're not. He's not spending all of his day around here. So it's understanding what is the next phase going to look like, and how are you going to plan for it, and how much time do you have to plan for it? That's another issue. People think you can just sell a business in the next month or so, and that's not usually the case.
Okay, thank you. And then just as a response to that, what is the sales cycle of your average transaction?
Hi, this is Paul. Yeah, I would, Paul Cronin, I would concur with the other statements. I sort of simplify the answer as, am I going to be, the question rather, a lot of business owners ask, if I sell my business, am I going to be okay? And okay deals the financial, the personal, the emotional, all of that. But if you're an advisor to business owners, you need to be prepared to help them answer that question. Here's how you're going to be okay. In terms of process, your next question there, Steve, I sort of break it up as this way: is if your business is sellable, expect it to take about a year. If your business is unsellable, it will take no time because you'll never sell it.
Okay, well, that's good. Which leads us to the next question, really. So let's start with valuation, because I think there's often a lofty idea of what your business is worth based on your own personal sweat and tears as opposed to the facts. Paul, can I go to you to talk about, just sort of in brief, what a business valuation is about, and what does it tell both the buyer and the potential seller?
Sure, thank you. I just want to agree with Paul and his. I always say when I talk to a buyer or seller, there are no wrong answers. It's what's right for you. And evaluation, it's very. People always say, "What? Just give me the number." Well, the number depends upon who the buyer is, who the seller is, what the purpose of the valuation is, when you valued it, and all the other circumstances. So a good valuation, I always say, Bob Karlis, you're the best valuator there is in the world. That business broker, he knows what that shop across the street is going to sell for. My job as a valuator is to tell you why it's worth that and to show you how does your business compare against other metrics, industry metrics, IRS metrics, bank loan metrics. And so here's a way you can improve your business. As Paul was saying, it takes a year to sell a business. Absolutely right. Let's get that business up and running as clean as it can be. And that's what evaluation should help clarify. Yes.
Can I ask, when you're doing that, you're valuing a company, do you also establish like their basis
Oh, absolutely. Sure. We
as
look at
part
the
of it?
balance sheet and what did you buy? I look at the book value, what your basis is, and then what is the fair market value or
Yeah,
the fair value, so
right,
one item that now has three numbers
right.
already, now
Yeah.
try multiplying that.
Okay, and so part of that equation, and maybe you can just respond to this. Many people have these false ideas that, you know, my weekly newspaper that I've published in some small town is worth twice the gross revenue, annual revenue. How do you respond to those kinds of questions that people have sort of these sometimes false or misunderstood senses of that valuation?
Well, I first asked him, what would you would pay that? Guess what? There's a business right down the street that actually the same employees come over at the end of the day and work at this company, and they have the same client base. How much would you pay for it? That's not usually the same number. I mean, I have a case now where I have a stock disposition, and of course, he wants to buy the remaining 11%. He thinks it's worth nothing. Well, what would you sell the company for? Okay, almost twice as much. Why do you see this disconnect here? So you always have to look at the opposite side. If you're the seller, how is a buyer going to look at your company? You may not see any risk there, but a buyer might. The risk may not even be real, but to the buyer, it is real. And same thing with a seller. You think it's worth a fortune. Well, is that because of you? Is that personal goodwill? A lot of entrepreneurs make themselves invaluable. Well, I can't sell that. Lincoln outlawed slavery in 1863. So you've got to get your personal goodwill out of the equation, and that's tough in some cases.
I'd like to jump in and reinforce what Paul says. As a business broker, I got a great example of why an owner should have some outside input on valuation to perhaps bring them into reality. I had a business that I had listed where I brought in an offer of 3 million, and it was a great offer. And I'm sorry, of 2.2 million. And the owner said, "Oh, I want 3 million. I'm not going to take 2.2." And I said, "Well, with my research, that's a very appropriate offer. Please reconsider." "No, I want 3 million." I brought in a second offer, 1.5 million, not 2.2. Oh my goodness, I don't even want to talk to him. Third offer I brought in, 1.2. Wouldn't you know it, the owner says, "Hey, call up the person that offered 2.2 and see if they're still in the game." And they weren't. So we ended up selling it to someone at 1.2 million and, hundreds of thousands lost. So whoever is out there that's thinking of selling, make sure you bring in adequate resources to educate you to the world out there and put some real perspective on valuations like Paul can bring.
Yeah, this is Paul Cronin. Yeah, I generally concur. What I would say is I understand the psychology that we're dealing with here. So there's this expression on Wall Street: the price is always right. Like the market is priced every stock is priced every day, and that's generally true. However, a business, even a valuation, is essentially a historical photograph. All right. It's good on the day it's done, but as the business evolves, the value will change. And I had a situation where I came in, he said I think the business is worth about 3 million. The seller was unhappy with that. Excuse me, the owner was unhappy with that. No, that's not going to work. Maybe I'll just keep running the business for a little longer. I said, okay, that's fine. And then COVID hit and his business almost collapsed. And so the reality is a business is only worth what someone else is paying for it at a particular moment in time. And as the economy changes and as the business changes and as competition changes, your value will also change.
Thank you. All good answers. Go ahead, Crystal.
So I was wondering, Paul Corrigan, when you're valuing a company, do you advise the seller on, or maybe there's the both parties, but generally the seller in how they should, I guess, allocate the proceeds according to like the tangible assets versus intangible versus goodwill and all that as well, like so they can maximize their depreciation and stuff like that.
Oh, absolutely. Yeah, I come back and say, here's what the goodwill is worth. Here's what the hard assets are worth. And that should be part of the asset allocation in the purchase and sale price. Now,
Okay.
what's interesting is that, of course, what the seller declares as his asset allocation on the tax return may not match what the buyer puts on it. And the IRS doesn't really check this. So I'm not saying do this, but
I see.
that's absolutely where you can come in negotiations where, as Bob Karlis said, the buyer wants 3 million. Well, you get terms or you get price. You don't get both. And a lot of times there's a negotiation between, well, I'll go down on the fair market value. Most of the time the buyer wants a very high fair market value on the asset so they can depreciate, which is much shorter in time in most cases than the goodwill, which is amortized over 15 years.
Mm-hmm.
So that's where negotiation can occur as well, or non-competes. That's another area where how is that taxed?
Okay, thank you. Someone else going to jump in? Is that you, Paul Cronin? No?
No,
Okay.
no, this is a
right.
great explanation.
Okay, great. So we've heard a little bit about buyer's remorse. Can we expand upon that a little bit? Where does the buyer have some remorse or concern as opposed to the seller? And we'll go back to the seller later.
Well, I deal with buyers with every deal. It's the buyer's concerns that have to be addressed before they're comfortable to go ahead and make an offer. And, the most obvious one is, can he replace the president now there running the business? Does he have relationships or skills, whatever, that are going to be lost? So huge concern and fear on buyers. How about customers? Are they going to jump ship when there's a new owner of the business? They may have had long-term relationships with the prior owner. How about the employees? geez, they're going to worry about the employees jumping ship. I'm doing a deal right now, as it often happens, where one of the key people is interested in leaving the deal, leaving the business because it's being sold. So, with a broker reviewing your business before you take it to market, you can perhaps address many of these fears and make the buyer much more comfortable in buying the business, and perhaps they'll pay more for the business if you've addressed these concerns. So, good examples of why you should have someone knowledgeable come in and help you prep the business.
Thank you,
Yeah,
Bob. Paul Cronin, I was going to just say, please,
yeah, no,
please give
thank
us
you.
your.
Great point. I advise business owners and other advisors, on the M&A processes. So when a buyer signs an NDA, they see the blind profile or an ad online somewhere, and they click the I want to sign an NDA. And once they sign the NDA, it's kind of like the first date is already over. All right, all that excitement is done. All right, and so now they're reading the one pager, or maybe they're going into the data room, and from that moment on, they go from I'm buying a business to I don't want to get screwed over. All right, and what I call is that buyers essentially are in the risk reduction business, kind of like bankers, right? Um, and so I've never been disposed to write a book, but if I were foolish enough to write one, it would be called Sellers Are Crazy and Buyers Are Nervous, and They Should Be. And you can read everything you want into that.
Okay. All right.
Right on the money.
That's a good
Right.
anecdote. Yeah. Very nice. So, um, what are some of those concerns? So, let's start with maybe a punch list of, you know, let's look at the concerns of the seller, right? So they're starting a whole new chapter of their life. They're certainly transitioning. What are the some of the things that they really need to take a hard look at, both professionally and then personally, in preparation for that transition?
Well, the big question is, am I getting a fair price for my business? Just jumps right up. And that's where the Paul's going to help. And I encourage everyone interested in exploring selling the business, get some outside, realistic, real world input on valuing your business. Got to be addressed up front, because if you're not comfortable with the price, you're not going to accept an offer.
Yeah, I would say there's three sets of goals every business owner should put together. And I have this exercise, and I'm happy to share with anybody on the call here. You can't copyright, but it really starts with a remarkably simple question, but something like all simple questions that are really hard to answer. And the question a business owner must ask is, what goals can I accomplish by selling my business? And the three sets of goals are business goals, personal goals, and financial goals. Unfortunately, 90% of the conversation around this is on the financial side. What's the value you're going to get from this? What do you have to say for assuming you're going to retire? What, et cetera, et cetera. But if you actually start with the personal goals, all right, you'll get a greater sense of, okay, it's important for me to my sales manager be retained by the buyer. Okay, it's certainly not a business goal. It's not specifically a financial goal, but it's a personal goal. A business goal could be, gee, we just launched this new product. I'd hate to see a buyer kill it. We work so hard and put so much money into R&D. I really want the buyer to make sure this goes to market and successful, because I think it will help the company be successful, et cetera. And then a financial goal could be on one hand is I need a certain amount of money to retire, but the other could be is, I really want to give each of my four grandchildren $100,000 529 account, right? Which is a little more personal than financial. And what I share with all business owners and their advisors is nobody gets everything. You may not get the bag of money that you're expecting, but if you've also gotten most of your business goals and most of your personal goals, That's a darn good trade-off.
Okay. Really good. Paul Corrigan, you want to add anything to that?
No, very, very well put. I think no business sale is purely financial. The price usually at the P&S when the deal's done, that's pretty much usually a pretty accurate price. But there's usually a large emotional content in there. And I think the trick is to figure out what is the buyer's motivation to buy and what is the seller's motivation to sell, and why does this deal work for them. So you need to look at some of the other factors that revolve around the sale and figure out how does that work best for everyone.
Okay. And so if the both parties, both the seller and the buyer, are smart enough to develop a team to help them through this process, who should be on that team?
This is Paul Cronin. I would start with what I would call the holy trinity of all business owners, and all the Catholics are smiling when I say that. But for a business owner, it's their lawyer, their accountant, and their financial advisor. Because no business owner is going to sign on the dotted line until each of those three people have answered their question. Hey, if I sell this business, am I going to be okay? And the lawyer can look at the various aspects of the deal, or if it's perhaps an estate planning attorney saying, okay, this is in line with what we talked about. And the accountant can talk through all the tax implications during the deal, post deal, et cetera. And they say, yeah, you're going to be okay. And the financial advisor says, you know what? Based on what you described, based on the financial goals he thought, yeah, I think you're going to be okay. That's the holy trinity. Guys like me, we're generally the last advisor a business owner ever hires, because we're essentially hired guns in the eyes of most business owners. I think we bring more value than that, but that's how we're viewed.
Paul's right on the money. Whenever I talk to a business owner who's thinking of selling, I say, do you have your business team together? And oh yeah, I got a lawyer. My brother-in-law sells real estate lawyer. Well, that's not an M&A lawyer. So I really push them to put together this holy trinity, as Paul said. And then I always pop the question, can you go on a 2-week vacation? No. Oh no, the business would fall apart if it. Well, then you haven't transferred your capability, your knowledge, and your involvement to your staffing to run the business. So you're a real key person, and that's going to be a detriment to someone interested in buying your business when you leave. So that helps point out the need for preparation, pre-sale effort, among other things.
Now, I'll just chime in there. I certainly agree with everything that's been said. I think it's important to have those that right trinity be the right people. You don't want a divorce litigator to handle your business sale transactions. Maybe a second view on the financial side might just uncover some areas that haven't been thought about. So just make sure that the people that are guiding your ship are all pointing in the same direction.
And this trinity is required for the buyer as well. He needs that accountant to review the numbers. He needs a lawyer to help negotiate and close the business. So it works on both sides, that you need qualified support.
Okay. And so thank you for that thorough answer. The next question I have in my head is how does that business owner prepare for his sale in a manner that that business can continue to operate and function without him? That what are the pieces that he needs to have a solid framework to pass on?
Well, obviously, Steve, it depends on the business with their different personalities and strengths and weaknesses. But, you look at what are the responsibilities of the owner. Sometimes they're really hands-on, and those are the skills that have to be covered by others underneath to be trained. Or maybe they're strictly marketing sales and they kind of let the business run itself. And so you have to look at what the owner is adding to the business to then identify what key skills have got to be duplicated or covered. Many times, I would request the owner would stay on to train the buyer in that specific skill rather than augment it before the sale. Very often, they're staying on to train them in whatever their contribution is to the business.
No,
Yeah.
I would agree with that. I've had, but a lot of what I also say is that a buyer learns much faster than you think, and a seller is much happier to move. I think it's very great to have a transition period in there, but I had a case where it was an antiques magazine, and it was a 58-year-old woman buyer and a 63-year-old woman seller. And they got along great. With this, they will sell this through. We love each other. We're going to work together for 6 months and everything. And as the deal went on, they got more and more contentious until the lawyer said, Paul, how are you keeping this deal together? By the end of the deal, it was less than a week. And on day 3, after the deal had closed, the seller came in and said, I know she's doing it better than me, but I don't like it. And I'm like, well, maybe it's time for you to move on. People just don't like to see changes to their business, whether they're better or not. So, but buyers learn very, very quickly as well.
Yeah, I would say.
Reminds me of a trick that I use quite a bit. When the seller is going to stay on, generally I would recommend a couple of weeks a freebie, but thereafter they should be on the payroll. And the buyer gets pretty fed up pretty soon with paying them to duplicate the work that he's learning. So more often than not, they're gone on a pretty quick schedule. So that works very well in encouraging them to sever that
Yeah,
relationship.
I would concur. So typically, if you're doing I'm in the lower middle market, so companies might sell for 10 to 50 million, and so it's mandatory that a seller is going to sign a contract, 18 to 36 months. 36 months sounds like hell to most business owners, and I tell them, by the way, you'll actually go to purgatory. About 18 months, you'll be freed. And for much the same reasons. Remember what I said earlier, buyers in the risk reduction business once they sign the NDA. And so once they've closed the deal and they've gone through all the post-closing documents and the escrows and everything else, and they got a feel for the employees and the vendors and the customers and so forth, they do the meter is running, as people say, as was said earlier. And so I typically say take the contract that you've signed, the length of the contract rather, and cut it in half. And that's psychologically where you think you'll probably end up leaving. And that's the amount of money your contract will probably get fulfilled. You can always negotiate for a little bit more. But if as long as you go in with that mentality, you're more likely than not going to have a successful transition post-close.
Okay, and so let's talk a little bit about the staff themselves, right? If we're talking about, small and middle market companies, oftentimes the staff are part of the fabric of the company itself. And retaining them or someone like them is probably fairly imperative. At what point do you actually reveal that something's happening, and how do you maintain communication, useful communication with staff people?
I guess I'll start. So I tell every business owner, identify up front who the people are going to you're going to need to tell or get information from about the business that will help the buyer execute the sale. Typically, some kind of a finance person, their accountant, their lawyer, but sometimes there are other people involved. And once you've done that pre-sale, the second part is you have to be prepared to pony up. Right? It's very likely that these individuals are going to realize the value they have in one way or another. I'm going to make it clear to you that they're going to expect some compensation. They may not look for shares or any of that. I would advise against that, but certainly be prepared to come up with stay bonuses to keep the person through the close date. And on the other side of the table, the buyers for key people should be budgeting stay bonuses to keep those same key people around for 6 to 12 months, whatever your budget allows, how critically important they are. Because when it comes to people, they don't have a stake in the business other than it's their job. And if they're skilled and valuable and they can move pretty quickly, money talks and everything else walks.
I have to jump and say I agree with everything you said, but one recommendation I make to business owners when I'm able to talk to them well in advance of trying to put the business on the market, when they're first thinking about it, get some golden handshake insurance packages for those employees that are really key to the business. And in a year or two, they've got some vested monies in there. They're going to think twice about jumping ship because you've locked them in with hopefully a good incentive package. And that can work very well if there's concern about employees jumping, as well as stay bonuses or other things. But that's when when things are on the table and things are obvious. So well in advance, it helps to plan.
I had a case where the transaction was completely oblivious to the employees. In fact, as the deal closed, we marched in. Literally drove 2 miles up the street, walked into the office. The new owner sat down at the president's desk and said, "Bring in the employees." And they all walked in and said, "I'm the new owner." And they all were shocked. But he actually gave 2 or 3 of them a stay bonus, and very small, $1,000 to $3,000 to stay on for another year. And they all signed it right away. So it was a small gesture, but it was just such an easy smooth over for the entire process.
I have
Okay,
a good
Crystal.
question. And so this might sound like a crazy question, but I actually had this question posed to me, and I feel like I know the answer because it sounds sort of shady. But I'm going to ask because this client is posed the question, and you guys are the experts. So they were wondering because they're trying to transition their business to a key employee, but they didn't know the process at all. So Bob, that kind of the steps that you provided to me were like key because they really didn't know even where to start. And what they thought, which I knew this wasn't going to fly, but they thought that they could just give it to the employee, like they didn't, the value of it wasn't, important and stuff. And so when I kind of explained that, basically the IRS needs to know who to tax. So you must have a value, stuff like that. And, the buyer has to have, skin in the game. You can't just give it away. They wondered because I think that they feel like this buyer, the key employee, doesn't have maybe any way to put a down payment or anything. And so they asked, well, is it possible to close your business and then could that key employee just reopen it? So sounds shady, so I'm sure the answer is no. But I guess I was curious how you would respond to that.
Well, the IRS considers economic substantial control or economic benefit from a transfer of something. So did he have substantial control if they gave it to him? Yes, they did. So the IRS is going to want a value for what was gifted, I guess, in this case.
Yeah.
Can they shut the company down? Yes, but then the new guy starts it up. What's the basis for what has been closed down? And again, what is the new guy basis for starting it up? So in any event, you need some kind of value.
Yeah.
And you can this is Paul Cronin. You can even if you don't use a bank like an SBA insured bank loan, the seller can offer a promissory note. You say, okay, the business
Right.
is worth
That's right.
$100,000, and there'll be 100% seller's note, right? $100,000. It has to be a market rate interest. I'll let the accountants and lawyers judge what that is. Let's call it 6%. And typically it's like 7 years. So, okay, you, Mr. Buyer, Mr. and Mrs. Employee, you're going to pay us, the sellers, $100,000, 6%, monthly payments, quarterly payments, whatever it is. And, at the end of that, it's, you've got it. And then so that, that should satisfy any legal tax issues involved. And over 7 years, 100,000, assuming to be a relatively nominal amount of money, but enough money that there's, it's not nothing. It's, you do have issues related to inventory. Say if it's a retail business, the inventory is typically going to be worth more than 100,000. So you'll have to really think through that. But whatever the number is, you can deal it as a promissory note, and that the buyer doesn't have to have any quote cash down.
Right.
I don't advise that. Quite frankly, you do want the buyer, I think, to have something. I don't care if it's. I mean, put it this way: if somebody says, "Oh, I'm going to buy out my my employer," right? You probably have friends, families, or fools who help you come up with $5,000, just to have some skin in the game.
Right.
Just and that's just my personal professional opinion.
Yeah. No, that was kind of the direction I had steered him, as an installment note, because of that no down payment needed. And also just that idea that no one appreciates something that they did not, make an investment themselves in. So that just
True.
like good sense.
Yep.
But I think that question of whether they could just close it, and then that the buyer assumes it and reopens it. So Paul Corrigan, you mentioned that what's his basis. I mean, would he be able to just reopen it and have you value it at that point?
Well, yeah, I mean, in his case, the basis would be the 100,000 that Paul Cronin mentioned. If they were to shut it down that way, and then bring it back up again, that's the money that was invested. That's the equity that was put. It's a debt, but it's also the equity that was put into the company, because the company gave, essentially the old company gave the new company $100,000. He went out and bought $100,000 worth. Guess what? Existing equipment, and there's the new company. But it needs to be formalized. I think, as Paul said, is that there should be a note or some sort of recognition of what's going on. I mean, it's interesting so the question becomes, if I do a lot of estate valuations. Well, most estate people want the value to be zero. I don't want to pay any estate taxes. It's the estate that pays the tax, not the giftee. So there's actually a law that says if the IRS comes back and says my valuation is too low, I personally, as the valuator, have 20 to 40% of the tax owed. I owe the IRS above and beyond what the estate owes. So am I pretty careful about this?
Right.
You betcha.
Yeah.
That can be a pretty big risk because I'm doing a $73 million estate right now. I don't want to be wrong on that.
All right. So, so one of the other issues I think that's worth talking about is that I'm guessing you folks have people that come to you whose business is not worth what they'd like it to be, and they need to build value to exit where they want to exit. What do you say to them when you feel they're really not ready and that they could be doing something to enhance the value of that business and create a more formal structure that makes it more attractive to buyers as well? Any sort of long-term building or even short-term building advice that you have for business owners who are looking to transition?
Well, I'll do the easy shovel here. I very much look at the expenses and compare it to what is the industry and other sectors look at. And a big example for me is always payroll expense, because I'll see the same company, same number of employees, same payroll distribution, and one's paying 5 times what the other one is. And payroll companies every year they nick on another. It's only a nickel per check per employee per run, but after 5 years it adds up. Or insurance, or your cost of goods. Why are these out of whack with what the industry is? So look into that. So it's just simply let's get expenses. I had a case where the owner died, the widow's running it. The son says, "Well, I just got into QuickBooks." Well, that now the fact that they can produce financial reports, it's the clarity and transparency of that business that's going to give it more value.
Yeah, those are excellent points, and I continue to revert to it's like what's going to make the business not just attractive but transferable. So yes, you can want to look at and generally what drives value for smaller businesses is a multiple of the EBITDA or profitability of the company. And so if you have a valuation done or I do a market sort of comp val and comes in and I say, hey, the business is worth 5.7 million. Like, oh, well, I need at least 8 million. They said, all right, well, you've got, how would you get that delta? Well, how would you adjust that delta? What kind of expenses? What kind of revenue would you need to generate? And so forth. And anything you can do on a profitability basis, let's assume the multiple is 5, right? So if you can save $100,000, all right, or increase your profitability by $100,000, theoretically on a 5x, you've just increased the value of business by $500,000, right? Simple arithmetic, not simple to do, but focus on the fundamentals. What are the financial, the operational, the sales and marketing, okay, and then sort of the governance, legal issues. If you can break down each of those 4 areas, it's a SWOT analysis. Get into there, get some people to help you. Right? This is not a cost-free process, but if you can get some people to help you in each of those areas, all right, increase profitability, reduce risk, then you'll end up with a better value. And value really is a range, so you can have the same company, a dry cleaner, and the range of value on that could be 2.8x to 6.8x on the adjusted EBITDA. It all depends on the strength of that business, the size of that business, and all those core elements.
I think we overlooked one of the biggest factors in increasing the value of a business. Put all the money on the books. I can't tell you how many restaurants there are who get paid in cash who are at break even. Time and again, it's temptation, which over time gets out of control. I had a big dealership I sold some years ago where both of the owners bought second vacation homes on cash out of the business. And they had to wait a year to put it on the books, so there was real proof of income. And, I won't, how many used car dealerships have told me, oh, trust me, everybody does it. I don't care. When the bank looks at your financials, they want to see it in black and white.
Yep.
So, not to throw cold water and everything, but that sure helps.
And then one comment from a marketing guy is maybe you increase sales, right?
Oh,
Maybe.
yes.
Well, yes, you do, but as importantly is you want to be able to show the buyer that there's a system in place to replicate the sales, particularly if the owner is like the sales guy,
Yeah.
right? And if that's the case, you say, wait a minute, in other words, I have the ability to attract an audience, leads, all right, I generate sales ready leads, and then I can convert those sales ready leads. And here's the system I have in place. And when you have that system, all right, you can grow a business with the system by adding more resources to it. Just put more cash up front. Okay. You get more marketing, you better qualified marketing, and then you've got a sales process in place, you convert, and then you go. But that assumes, okay, that those sales are profitable sales.
All right. Well said. Okay. And then another question I had was, so I think having dealt with a lot of CEOs along the way myself, I know that sometimes their life can be very one-dimensional. They pour themselves into their work, and outside of that, there's not a lot that they've ever really um, spent their energy on, right? And so to leave that identity of work and that time and that focus is frightening to them. How do you prepare them for that next chapter? Who do you put them in touch with? What do you do to get them onto there's life after work?
Yeah,
I
this is
think, go
I
ahead.
was going to say this is such an amazing question. Thanks for bringing it up. It is a true conundrum for a lot of business owners. It's called the 95-5. 95% of their time, effort, energy, etc., is the business, and 5% for everything else. Think about that for a second. 5% for everything else. You take away 95% of the reason somebody gets out of bed each day, they get a long hill to climb. And I did a lot of coaching in this area, but there's a thing called a framework for purposeful living. Imagine instead of 95-5, it's the opposite. All right. You're going to spend 5% of your time on some kind of income producing work and 95% on everything else. Right? Physical health, intellectual health, spiritual health, time with family, time with friends, social interaction. And if someone spends enough time sort of working this sort of wheel that I described for people on those things, all right, not the day after they close, but 6 to 12 months ahead of time, instead of going to the closing table with dread, they're going to go on with running shoes. Like, hey, how quickly can I get this thing going? I've designed a new life for myself. 95% of business owners don't do it ahead of time. Everybody eventually gets around to it. But if you can do it ahead of time, and whether you hire a coach or you read some books or, follow people like me who write about it on LinkedIn, you can work on this. All right. This is to say, no one's ever accused me of being a genius. All right. But even I figured this out after I sold my business.
Okay. Bob or Paul Corrigan?
Um,
Well,
I think this harkens back to the question that I said earlier that I asked the owners, and that is, can you take a 2-week vacation? Um, if their hands are so tightly wrapped around their business, they can't take a couple of weeks off. It's an indicator that they don't have any other life, too. So the degree to which they're enmeshed in the business shows this. And another great question is, what are you going to do with your wife or your family after you retire? What goals do you have beyond this? And they say, "Oh, I don't have any." You say, "Well, work on it, because it's going to be pretty lonely if you don't have something to occupy yourself next phase of your life."
I usually ask to bring your spouse or your partner in as well if you're thinking about this, and what are their thoughts about it. I literally had one case where the gentleman said, "Well, what?" crossed his hands and go, "Well, what if we get divorced?" And I looked at, well, I don't know how that might work out, but at least he was being honest about it. And you always want to get the second opinion there. So
Yeah. Well, so my last question really is, let's say someone who watches this in particular as a recording, and they're thinking of making a transition, selling their business. Who's the first person they really should talk with? Where do they start?
Well, here I am. Cabot Business Brokers got to be their first call. No, honestly, they should talk to someone who has handled transactions and can bring that experience to the fore to help them anticipate some of the issues that are going to be uncovered, some of the problems that should be addressed prior to taking the business to the market. And that's why I love to talk to business owners months, a year or two in advance, casually, but just to sensitize them that they have to start thinking about more than just their specific responsibility. They have to put themselves in the chair of the buyer and look at what deficiencies there may be that they should address or reinforce before they then go to market.
Yeah, I would say my experience is that a lot of business owners, they sort of first raise this question with either their accountant or the financial advisor, because they tend to have, a business and sort of a personal relationship, sometimes with their business attorney, but not necessarily so. And part of the process, like, admitting that you know how to grow your business, but you don't know how to get out of it. And so if you get a little, sort of opening the emotional kimono a little bit to two people you really, really trust, who've been through it before, helped other owners go through it, they can give you an absolutely, PhD, generally speaking, on some of the things you're ahead of you. And then I offer this to other professional advisors in my network. This is, if you've got a business owner who has never talked to a scoundrel like me, but just has some question about the process, you can give them my phone number. Just tell them, Paul Corrigan said it was okay for me to call you, or whoever. I will give them 20 minutes of Q&A about M&A, not unfiltered, right? It's got to come from an advisor, so there's some semblance of rationality, hopefully, on the other end of the phone. But I find that, after they've spoken to one or more members of that holy trinity, and that person gives them mine, I can have a really solid 20-minute conversation and help them get a sense of, like, this is some of the M&A issues you're going to deal with, and you might want to spend some time thinking about it before you go sign a contract with a scoundrel like me.
Okay. And
Yeah,
Paul
I
Corrigan?
think it's important. Don't talk to the guy at the 19th green about how he sold his business. Okay, talk to those providers. Hopefully, they will bring up things you hadn't thought about, and that's really, I think, it's the landmines you don't see that kind of get you. So make sure you have a clear understanding of what it does mean. How's it going to affect your spiritual, your family life, your financial advice? The employees are very big. How does it affect your health insurance? Those factors as well. So make sure you talk to enough people that you've covered all the bases.
Great. Well, that sort of brings us towards the end of our hour together. Is there anything that you'd like to shout out that people should think about that we didn't cover today?
Yeah, this is Paul Cronin. I'll just sort of jump on the last point made there. The question I asked earlier, business owners ask, "Am I going to be okay?" And it's a critically important question. But a lot of business owners often think about their employees as, team members or in some cases family members. Well, every employee, once they hear either through the grapevine or at the announcement that company's been sold, what question do you think they're asking? Am I going to be okay? They're not thinking about the seller. They're not thinking about anybody else. They're not thinking about the buyer. They're like, hey, am I going to be okay? So you as a business owner, if you have that kind of thought about your people, are my people going to be okay? Can they answer that question for themselves at the end of the announcement? And if you've thought through that, hopefully beforehand, you'll not just pick the buyer, but a term I learned a long time ago is you will have chosen your honorable successor.
Really good point. Thank you. Any other parting words before we conclude? Yeah.
I totally support what Paul just said about an honorable successor. A couple of years ago, I had a home healthcare business I sold, and being a hot market, got offers from everywhere, but the owner ended up turning down the higher offers to sell to someone who they thought would be a better owner for their concern over keeping the staff and how they would support the staff post sale. So, real key thing here is worrying about your employees through the process makes for a better deal if the buyer also knows you've thought about it and they're less concerned about them jumping ship.
Right. And Paul Corrigan, any final comment?
No, I think that all makes great sense. I had a buyer, one very crusty old guy, and couldn't get along with anyone. And then he met this 35-year-old buck who was the young son, and he was willing to do seller financing and help and stay on afterwards and work with this guy. So finding the right buyer is key. And again, you got to get beyond the financial side and figure out what's the reason behind both sides want this transaction to work, and nobody wants it to fail. I always tell the buyer doesn't want to fail, the seller, the bank, the attorneys, the brokers. We all want this thing to work, and that works best when everybody's a good guy.
All right. Well, thank you so much for your time, your wisdom, your honesty and candor. It's been a great session, and I look forward to following up with you on future topics. Thank you so much for being with us today, everybody.